I promised that I will be in Bahrain on the 24th of May, Friday. The location has been fixed. It's Hotel Rami Grand, opposite to Seif Mall. Those desirous of meeting me in Bahrain can contact my team at the WhatsApp number given below or drop an email at the email address given below. See you in Bahrain on the 24th of May.
Hi everyone, welcome back to Be Rich. It's me Vinod here today, and I want to quickly round up on what Anand spoke about MoneyPechu before I jump into my main topic of discussion, which is going to be intrinsic value and relative value, and how each has its pros and cons, and how one may calculate one against the other. Before I get into intrinsic value and relative value, I want to tell you what Anand said, which is the Dow has hit a historic high of 40,000 because the market speculators feel that rate cut is imminent because of the way things are positioned. But Anand feels that rate cut will not be forthcoming anytime soon, because if you look at the job data, it doesn't make sense cutting the rates right now. So with that in mind, Anand feels that gold is a great buying opportunity for those who are considering. So he says gold is something you can consider. It is going to be at range bound at these prices for the next 12 to 24 months is what Anand feels. So if you have not managed to accumulate your 200 grams of gold, and you do not know what stocks to buy or mutual funds to invest into, and you have some cash sitting on the table, maybe you can consider gold. That's Anand's opinion, and I want to share that with you. In his video, he dives deeper down into other companies, Indian companies specifically, and where they are, and which ones you can consider. He did talk about Vodafone, and like I said, I had spoken about the Vodafone FPO, the follow-on, and that was a one-off thing. I'm not ever recommended that you buy Vodafone, and the reasons are very apparent. The losses are widening in Vodafone, and this is why you cannot look at Vodafone at the near future. If you are looking at it and you're in a position of profit in Vodafone, maybe you can consider exiting it. Even if you're in a considerably lost position in Vodafone, maybe you can still consider cutting your losses and exiting it and moving it somewhere else, because it's going to take some serious doing by Vodafone to recover from where they are right now. This is Anand's analysis, and I agree with that. I'm not asking you to invest in Vodafone, so don't get confused with the Vodafone FPO video. That was a one-off video only for the FPO and nothing more and nothing less. So this basically covers about what Anand spoke in MoneyPechu, and you can watch the rest of it, and do watch it. It's far more in-depth than what I'm speaking here, and it's a great video. What did I want to talk about today? Today I want to talk about intrinsic value and relative value. As a stock evaluator, as a value investor, this is one of the tools we do have: intrinsic value and relative value. Both of them have their pros and cons. I'm not a big believer in intrinsic value. At the end of the video, I'll tell you why I don't believe in intrinsic value being of any great use compared to any other method such as relative value. There are people who preach about intrinsic value, and it's a great way to evaluate a company. And I'll tell you why the problem is. It is a great tool, but it requires a lot of finesse. And by the end of this video, you'll understand what I mean by finesse. All tools are wonderful if you know how to use them, as it famously has been said. So what is intrinsic value? Intrinsic value is, let's say we talk about you want to buy a house. So if you want to buy a house and someone quotes you a price, how do you judge if that price of the house being quoted, is it correct? There's two ways you can look at it. One, you can look at the rental income of the property, the rental yield, as they say. That is intrinsic value, what the property can give you. And based on that, you can ascertain if the price which they're being asked to pay, is it correct? Is it right? The other way is you can compare all the houses in the same area or in the same building. What is the market saying over there? That is known as the relative value. So I hope you understand the difference between both the concept, what intrinsic value is and what relative value is. So when it comes to a company, the way to calculate intrinsic value is completely based on its cash flow numbers and the manipulation of its cash flow numbers. You do something known as a DCF, which is a discounted cash flow calculation. And to do DCF calculation, it's a very simple equation, which is present value, PV, which is equal to the cash flow divided by 1 plus the discount rate to the power of n, where n is the number of years. Cash flow is what the company is expected to make each year, which you will have to ascertain. Discount rate is a percentage which you adjust to the future cash flow to the present value. It's a way of thinking, accounting for the time and value of money and the risk to investment. So you're discounting. That is also up to you what you put. And the present value, that is the today's future cash flow values, is what you're calculating. So what you do is you take the expected cash flow and discounted rate, and you plug it into the equation which I said, and n stands for the year. So the first year is 1, so it's to the power of 1. Second year is 2, so it's the power of 2. Third year is to the power of 3. So you take the sum of these. See, it's getting complicated as I'm speaking. But it's not even got to the fun part is that why I think this is not going to be very useful for you. So now what you do is you do this for 10 years and then you take it 10 years calculation and you add it all up. That gives you the total present value. That is the intrinsic value. That final intrinsic value is adding up the present value of 10 cash flows. And that gives you the approximate intrinsic value for the company. So what are the key takeaways? Well, the DCF method valuation helps estimate the future earnings and what it's worth. Are they worth today? That means the potential of this company. Is it worth at the price they're asking today? And the cash flow is the expected future returns. Discounted value, I told you what it is. What is this in comparison to relative value? Relative value is what we famously do is the PE ratio. We have the historic PE, then we have the current PE of the company, then you have the industry PE, and you compare and contrast all these together and you see, is it priced correctly, the asset which you're looking at. Anand always says historically in Nifty, the PE ratio is around 15. So anything below 15 is considered a good buy. It's discounted. Anything above 15, higher it goes, the more expensive it becomes. Like some of the Tata companies like Trent are trading at 100 PE, which means it's very expensive. That is what Anand refers to as Vaira Usi or diamond pin because it's at eye-watering evaluations. There are people who calculate the intrinsic value of Trent and they justify this cost saying, looking at the future cash flow of Trent for the next 10 years, it justifies the price it is being quoted today. Hey, there are two ways to look at every problem. So these are the reasons why some people argue that though the PE ratio may be at this, that is taking into the earnings, current earnings. But if you're looking at the projecting to the future as a value investor, you must, then there is still a lot of growth in this company. That is up for debate. Because the problem here lies, how do you calculate DCF? Do you take projections for 5 years? Do you take projections for 7 years? Do you take projections for 10 years? They say company which is calculated for a period of 5 years. So that has perpetually growth model or a multiple methods say 5 years is more than enough. Some say you should calculate for 7 years and 7 years is enough. And this lies the problem of the intrinsic value methodology of measuring. Then we get into the interesting part, which is the cash flow. Where do you get this cash flow information from? You cannot definitely open up the balance sheet and say, I look at the cash flow there. That's a past. We're talking about future cash flow. How do you know what's going to happen in the future? So that you have to study income statements of historic income, expenses, profit trends in the balance sheet. Using that, you're going to estimate yourself what is going to be the future cash flow. And there lies the problem. And then comes to a discount rate. Discount rate is what you think is a correct discount you should have going forward. That is also up to you. So basically, you're doing guesswork through a mathematical formula. So it's like me asking you, you coming and asking me or me asking you, how can I be a good radiologist? Study X-rays and scans. Is there an equation for it? There isn't, unfortunately. It is experience which makes you a good radiologist or a scan reader who's able to spot these things. Of course, some people now say AI can do it. I'm yet to see AI perform at the level of a doctor, but therein lies the problem. So you have to get a feel for this. And to get a feel for something like this, you have to pour over many sets of data and make many mistakes. And from those mistakes, you learn, and there you can get a feel for it, which is what Anand does. You ask, how does Anand manage to do this? Anand has studied many data sets and he's understood it, and now he's able to see trends. So if you want to calculate intrinsic value and you want to be a good stock picker like that, I suggest you do a hell of a lot of calculations and do a hell of a lot of reading and analysis and all kinds of industrial literature before you kind of start picking stocks using this. Anyway, I hope you found this video informative and entertaining and understood why I don't put too much water in intrinsic value unless you're very gifted at it. And I rather stick to relative value because that is much faster and clearer for me to help me evaluate stocks on the fly. Thanks for watching the video. Do put your comments down below and let me know what you thought of this video. And do you use intrinsic value and what methodology do you use for DCF? Give an example for Tata Motors. What do you think the future cash flow should be for Tata Motors? What do you think the future discount rate should be for Tata Motors given the current news and conditions? Would love to read that. Thanks for watching the video and I'll see you in the next one soon. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.